Nancy from Redfin here with Juan. Hi, Juan.
Hey there. Hey everyone. Juan Castro here.
We're going to talk about rates this week, and there's been some confusion, I think, why rates came down when the Fed said rates were staying steady, right? We're not going to cut rates, but yet we saw mortgage rates dip. And
Yeah.
full disclosure, me and Juan are only realtors. So we're not economists. Our job, going back to dating, we're matchmakers. We match buyers and sellers together, right? But we follow things so we can better serve our customers.
Yeah.
To kind of follow
Exactly.
what's going on and why it's going on. Right?
Yeah. Yeah. And we know that the Fed rate influences mortgage rates indirectly, right?
Indirectly.
It's kind of like a rubber band, right? A little bit of a
Yeah.
pull this way, a little bit of a pull that way. But we also know the Fed rate does directly affect short-term lending like car loans, credit cards, I would guess student loans, probably.
I'm not sure about student loans. I don't know.
But
HELOCs,
yeah,
I
but
think shorter
HELOCs,
term, not a 30-year mortgage. It doesn't
yeah,
directly affect,
yeah,
right? So the Federal Reserve's job is basically to to keep the economy in control, keep it balanced, keep it steady, right?
yeah,
That's their job.
yeah,
And they do that by raising rates, lowering rates, and that indirectly will affect buying a house
yeah,
or refinancing your house.
yeah.
So the last Fed meeting was the end of July. I don't remember the exact date, but they opted not to change rates. So they're keeping them high, right?
Yeah,
But a few days later, mortgage rates dipped. And everyone's
yeah,
like, well, I thought the feds were keeping the rate. And they did, they kept the rate. But what happened was after that meeting, we got the next job report. It wasn't available before the Fed meeting.
yeah,
So it comes out a few days later and the job market softened.
yeah. It didn't go negative. It's just a little softer than what they had hoped for. It didn't
Right.
create as
So it
many
was lower
jobs
than expectation.
during the last period that they had
Mm-hmm.
hoped for. So they consider it softening because it didn't hit
Right.
the prediction. It'd be like me running a 5K marathon and I could only run three.
Exactly. Right. So
So I
so
still did okay, but
you
I
did.
didn't do
You didn't
exactly what,
do right. And exactly, the job market was still growing. It just wasn't growing at the rate that was expected or planned for.
yeah,
So when that happens, investors look for a safer investment for their money. So the Wall Street people, right?
yeah,
Then they start investing in the bonds, right? The US Treasury
treasury
bonds
bonds.
and mortgage backed securities. And when they do that, because they're betting that the Fed is going to lower rates next month in September, I think it's mid month, 17th, 18th, whatever it is. So
Yeah,
they're taking a bet on that, right? When you work the stock market, when you're an investor, it's kind of a gamble.
yeah, long
So
term.
by them doing that, started dipping the rates, right? So the mortgage rates did come down. Yesterday we were sitting at 6.57, which was a 10-month low
Yeah.
from I think the high well in May was 7.08.
So it's half a point, and you got to consider that is for the person with like the 750, 800 credit score.
Yeah, absolutely.
So
Yeah,
if you
they're
got
the
a
ones getting the best
700,
rate out there, right?
yeah, so if you got a 680 credit score, that's still considered very, very strong.
Yeah.
You're not going to get the rate that somebody gets with a 750.
Right, right.
So, so that's why you got to be sensitive to that.
Yeah.
And that's why you have to have a good lender that can always keep track of the rates and try to perceive what's going to forecast in the future, like we perceive houses.
Right, right. We perceive that
We
and we
perceive the
perceive
value.
like
Yeah.
so if there's a chance, right? If rates do come down significantly, more buyers are obviously going to be out there looking. So we have more buyers. Sellers will be happy because there's a lot of sellers that are, the
Yeah.
houses are sitting. We talked about this before. If this brings more buyers out, it could balance the market. I don't think we'll go back into it. I don't know unless rates came down drastically. I don't think
Yeah.
we'd be back into a seller's market, but maybe we'll have some balance, right?
It'll be a neutral market.
Yeah, which would be nice because I'm used to highs and lows. Like strong
Yeah.
sellers market, strong buyers market.
Nothing in
I
the
really
middle.
haven't had that in between, but you've lived through it all, right? Because you're much older than me. No, because you've been doing this
Yeah.
longer than me. I'm actually older
Yeah.
than you. But
Yeah.
because you've been doing this for 20 years and I'm doing this 3 years, you've lived through all these different markets and the ups and downs of it. Where I feel like
Yeah.
I've just been like, boom, swung
Yeah. I
through
think
that.
I think the key is to realize that today is a moment in time.
Yeah.
Tomorrow is a different time.
Mm-hmm.
So, the odds are the biggest thing a buyer can do is to get in the water and swim to the house and get in there. If you never get in, you will
Right.
ultimately in the future get priced out long term. I've had
Well, that
customers
that would
that,
be the fear now because, well, first of all, we have I think three more data points before the next Fed meeting, right? So there's
yeah,
another job report and there's two more inflation reports that are going to come out. If the job report comes back even worse, rates could dip again before the next meeting. Or if the job report comes back better, I don't know, they can go back up. So it's timing too. Like, do you take the chance now? Do you wait to see the next job report or data report? Do you wait till the next Fed meeting? But if the reports come back favoring a rate drop, right, or predicting that there could be one, that interest rate is going to be baked in ahead of time, right?
yeah,
Because the investors are going to do their thing, the rate's going to come down. So it's not like with the mortgage rate that on September 18th, if they drop the rates, the mortgage rate's going to fall. It probably will fall ahead of time, like it just did.
yeah. Or
That
it
makes
might
sense.
stay very close to what it is now because they've
It
already
may,
cooked it
right?
in. I mean, if they drop it a quarter point, the banks probably will just stay at
Right, because we
six and a
that's
half.
already happened, right? That quarter of a point already happened, so it's already predetermined. But unless those reports come back with
Yeah,
lower inflation, right?
yeah,
So so the Fed playing with the interest rates is to control the rate of inflation. They want it to be 2% a year, and we're sitting at closer to three, I think 2.7.
yeah,
But came
yeah.
down from the 6 to 9% where we were at.
Which is significant. And it also
Yeah,
teaches us that sometimes we don't know why the Fed does what they do
yeah,
because they did lower rates at one time when it was in the 6 to 9% range, which made
right,
you kind of wondered, were they trying to shock the economy to get people to roll into it?
right,
What was their
exactly.
thought process? I mean, we'll never know. We're not at
We'll
that
never
level.
know that, but I
Yeah.
think those reports will be a telltale sign. The other thing that was interesting at the last Fed meeting that I think they're called governors, and that's kind of my nickname for you, so kind of funny. But two of the governors, I don't know their names, I don't follow it that closely, wanted to drop rates. And that was the first time, I forget what word they used for that, in
Yeah.
over 30 years that happened, that they all weren't on the same page. Like
Yeah, they
two of them
didn't
were
agree.
saying, hey, we gotta drop rates. Like people are struggling out here.
Yeah, yeah. Well, I think they realize that with rates being where they are, even very good, well-qualified people who don't have a lot of cash funds
Right.
are priced out of the market.
Yeah.
People like
Yeah.
you, people like I, and we always know buying a home is not a luxury, it is somewhat of a sacrifice. But it
Yeah.
doesn't have to be a live or die sacrifice.
Right. Right.
You
Exactly.
know,
You should be able to
it
buy a home in America and still be able to live your life. And
you should still be able to. I mean, you may not buy a home and have a chef at home and have 15 luxury cars at
you don't
home.
have a chef at home?
I do not, well, my wife is quite,
She is quite the good
yeah,
cook, but
yeah. I
yeah.
mean, obviously, yeah.
Yeah.
But
Yeah.
I think the key is that you have to take that step and get in. So you got to look for options to get in front of the rate because if the rate does go down, let's say it did go for some reason in the next 12 months from 6.5 to 5.99.
Yeah,
Yes,
or
homes are
even
going to
lower.
sell.
Let's say we go down a full point and we hit, by next summer 5.5. Next
Yeah,
next year we're going to have a new Fed
yeah,
person,
a new
head
chair.
guy, right? In May is going to change, right? Get
Yeah,
appointed,
yeah.
somebody new.
Yeah, so imagine in your mind, so right now there's more sellers than buyers, pretty much.
Right.
So all of a sudden, there's going to be more buyers than sellers, which makes it more competitive for buyers.
Yeah.
So the house that you could have negotiated today and built in some closing cost credit, even though you're going to pay a fair price, you could have built in closing cost credit. You could have maybe seen if your bank had an incentive like our Rocket Redfin incentive that helps
Right.
people get into the property. And then you could strategically look at in the next 3 to 5 years, if you had to, you could refinance,
Right. And you
readjust
might be
that.
able to as soon as next year, but we're not, again, we
Yeah,
don't have a crystal ball. I so wish I had
yeah.
that.
You may not
We don't
need
know what's
to.
going to happen. I, I'm on TikTok. So I did a TikTok yesterday about rates. Like, what's your number? What number would it take for you to get into a house? And I got a lot of responses, and a lot of people were saying, I need 3%. But we got to 3% and a little bit lower, but it took a global pandemic to do that.
Yeah,
We don't want that. We don't want that. And then,
yeah.
now people are priced out of homes because of what happened, right? The rates were so low. There was so many buyers out there trying to get a house at that rate that it, drove up the prices.
Well, the buyer pool was larger because they could spread more money
More
over
people can afford
3%.
homes at
Yeah.
3%, but look at what it took to get there. Like, we don't want
It's
to be there. We don't
yeah,
want
and
a
it was too
global pandemic to
competitive.
get us at 3%.
It was too competitive.
Yeah.
The prices were jumping significantly. I mean, I sold houses 75, 100,000 over list price.
Over. Yeah. They were waiving everything, right? And
It
I don't
was
want to wear a
ridiculous.
mask again.
It was ridiculous. So
Yeah.
I don't see those numbers happening
No,
again.
I don't think so either. I mean, you can get it with new construction. You can get close 3.99. We've talked about that. If we can be comfortable at some point in a balanced market, what are you saying? 4.5 to 5.5 to keep a balanced market?
I think between 5 and 6 is probably the
5 and 6,
rational
you
number.
think? Yeah, would
You
be the
know,
best market for everybody involved.
I think it would be most neutral. It won't be accelerating so much that
Right.
buyers get
And then
priced
prices
out.
won't, go up at that rate that they
Yeah.
did.
And then sellers can sell and they still can find the product to buy.
Right. Right. Well, that's the other thing. And then we're still in that position where a lot of people have these low interest rates. Even if they didn't buy when the rates were low, they refinanced, right? So we have a lot of sellers sitting on those really low rates. But if they came down enough for it to make sense to them, even though they're going to get a higher rate on their new home, but it might not be a huge difference as it
Yeah.
is
And they're going to get the
today.
equity out of their house.
Right. They'll get the equity
So
and
they're going to roll
hopefully
it.
they find that balance. Yeah.
Yeah. They're going to roll
And
it.
maybe they use some of that equity to buy down their rate in their next house. I don't know.
Yeah, exactly. I think the key is your personal timing has to be right.
Right. Of course.
You
Yeah.
got to run your numbers. You got to know what your budget is. You
Hmm.
got to experience the market with someone like you or I. See if
Right.
there's products out there within striking distance of your budget.
Yeah.
And if there is, you're ready to roll. If there isn't, why not? Is your
Right.
budget too low? And if it is too low, or if it doesn't meet the marketplace, why does it not meet the marketplace? Do you need to do some credit repair, which Rocket does?
Yeah.
Or do you need to maybe pay off one or two things like that $580 car payment that could give you leverage on a
It gives you
mortgage,
more buying power, right?
right?
Even those stupid little credit cards. So if you have, 5 different credit cards and you're paying each of them $50 a month, the balances are most likely not so bad at $50 a month. If you paid them off, that's $250 a month off your debt to
Yeah,
income. Yeah, and that makes a huge difference. Pay one off at a time. I'm not giving credit advice, neither are you,
yeah,
right?
yeah.
We're
Just don't
not
close them
giving
all. We
great
know that.
advice, but we're just kind of trying to explain what we notice, what
Yeah,
we're seeing, and what potentially could happen or not. I mean, rates could go up in September if the job report comes back strong. We don't know.
yeah, yeah,
But I think to recap this, right? We have a job report coming out, two inflation reports coming out before the Fed meeting.
yeah,
If those reports show if the job market is slowing more than last one, if inflation is getting better than it's been, or even staying the same, right? We can take that gamble. We might see rates drop by the next 3 data points. And I think I actually have the dates for them. Let me see. Okay.
Yeah, I mean,
September 5th is the next job report, right? So we still have a few weeks for that. Right? It's almost a month away.
Yeah.
I don't know what today's date is. Okay, the inflation, the next one is August 13th. So I think that's next week. That's the CPI, Consumer Price Index. And then we have another one on August 29th. So let's say the CPI comes back and we're seeing that inflation is either staying the same or trending down. We may see another dip. But if we see that inflation report went up, right, we might lose that gain that we just got in interest rates.
Which means somebody would have been favorable if they were prepared to do a rate
Right,
lock
exactly.
and
I
try to
think it's
find
going to
that
be
product.
interesting next week. And I don't want to do a whole nother podcast on rates, but it may be past, it might be when we're recording. So at least we can announce what happened on that CPI.
Yeah, that would be interesting. I've not reviewed
Yeah,
that
and just
before.
follow along with like what happens with that report and what happens with rates. What are investors thinking now, you know?
Yeah, what's the action and the reaction that happens?
Yeah. Yeah,
And
I'm excited to see and follow this along. But this
we
was
could see
fun.
it real time.
Yeah, absolutely. Yeah, I think it's pretty cool to see how things work. These are things that, before real estate, I didn't understand what the Fed did, and how it affected, us daily, really, and everything we do. Prices of
Yeah, I
everything.
mean, most people, including myself, for the longest time, believed that when the Fed said the rate was this, we thought the banks borrowed money from the Fed for that amount, and then they
Yeah.
added a piece. But that's
Yeah, that's what
really
I thought. I'm like, oh, they're making money. The Fed's charging 2% and they're charging me
yeah,
8%. Like, what's going on? Yeah. But that's not the
it's
case. That's not
but
how it
that's not
works.
the case. So
Yeah.
it's a learning process. You can't know everything about everything.
Right.
But what you can do is when you don't have the time or the bandwidth to figure everything out exactly, you can align yourself with people that are really good at that piece,
Yeah.
and then it makes you look like an expert.
Right. And again, we're not experts on the
Exactly.
economy or inflation or
Exactly.
rates, but we just follow along so we can help people the best that we can.
Yeah, that's all we want to do is give you some good advice and reconcile that with the banker, and
Yeah.
then everything lines up, we're ready to go. So we just want to get you there.
Yeah, absolutely. All right. This was fun. We'll chat again next week.
Thank you,
Have a,
everyone.
have a good week.